Good morning, everyone. Thank you for joining us today for our live Q&A series. This is the first of three, and we'll get into describing what's to come in our series. But today we'll be focusing on a bit of a Q&A session on all things PPP, what's happened, what's to come, and some of the common questions we've been hearing about. So I'm happy to be sharing some of that information with you all, and thank you again for joining us this morning. We'll start with a few introductions of who you'll be hearing on our end. First and foremost, my name is Mike Bolton. I'm a partner with Armanino, specialize in working with our nonprofit clients here on the West Coast, primarily in California. I primarily help with the financial statement audits, but also assist with some of our other consulting work. Joining me is Matt and Jason. I'll let them each introduce themselves.
So great. I'm Matt Petrosky. I'm a director in Armanino's nonprofit tax practice. So 100% of my practice is dedicated to nonprofit tax. I've been working in the area for about 18 years. And I also have been dealing with PPP since the beginning, even including the original House bill that has later been updated. So happy to be speaking with everyone today.
And good morning, everybody. My name is Jason Levy. I'm a consultant with Canterbury Consulting, and we'll talk a little bit more about Canterbury in a moment, but work with our nonprofits as well on asset allocation strategy for their endowment or foundation, and excited to be with you all today and to learn a little bit more about PPP.
And I'll give a brief overview of Armanino for those of you that aren't aware of who we are. Before I forget, we are recording the whole broadcast. It'll be made available to you shortly after we conclude. Within a day or two, you'll get an email with the recording. So feel free to save your quick notes, and you'll get the full recording with the slide deck and the audio that you can review later if you like. So again, if you aren't familiar with Armanino, we are a full-service CPA and consulting firm. We're headquartered here in California. We're one of the 25 largest CPA and consulting firms in the nation. Nonprofit is one of our specialties. We work with over 800 nonprofit organizations in all sectors of all sizes. And in the more traditional CPA work, such as tax compliance, financial statement audits, outsourced accounting, but also in some more unique ways. We have a public relations arm of our firm, and we also do a lot of software implementations and consulting, whether it be installing things like Intact or Microsoft GP products or QuickBooks consulting. So a quick overview of ourselves, and we will talk a little bit more about how we've been helping both conducting the survey and all things related to the current events of COVID-19. And so one of the things we've been doing in recent months is compiling a resource center. This is a snapshot of it, but we have on our website, if you go to armaninolp.com, right there on the front page is a link to our resource center that has a host of resources for you related to COVID-19, whether it be other recordings of past webinars, calls, presentations, quick, short, brief articles, or other checklists and best practices for not only the nonprofit space, but specific sectors within nonprofit, as well as the other for-profit industries that we service. So a host of information that has been very valuable to our clients in the greater community. This recording will be up there eventually as well. And a lot of questions that I know many of you have already related to PPP. There are answers already on our resource center. We'll go through some of those today as well to help give you some real-time information. Matt's been a significant contributor to that resource center as well. So Matt, if you have anything to add on what's up there, feel free.
No, I know there's definitely a lot of FAQs, so I would highly recommend taking a look at that. And we've actually given a lot of various webinars throughout. I would say maybe even in double digits, and some short, maybe 20, 30-minute bursts where we've recorded some key aspects of it. So if you're looking to really dive into the PPP and even some of the other CARES Act or other coronavirus resources, there's a lot there.
In just a moment on Canterbury, for those of you who are not familiar, we are an independent investment advisory firm that's been around for a little bit over 30 years. Advise on about $24 billion in assets We focus on mainly two types of clients, nonprofits and family offices. You can see on the bottom of this page, the nonprofits are similar to many of the organizations that are calling in or represented by many of the organizations on the call today. Community foundations, educational, religious, arts and culture, healthcare, as well as the family office type clients that we work with as well. And our objective working with clients is to build custom investment programs that align with our organization's objectives and unique missions. We believe that each client has different objectives, different time horizons, different biases, and most importantly, different missions, and therefore deserve and need a unique and custom investment program and asset allocation to serve that. And so we work very closely with each organization, their staff, their committees, their boards, to understand all of those items and then to deliver a custom program. And I'll say that sort of transitions into the next slide, because as we're working with clients and as we were talking to our clients in March, and as the crisis was really increasing, and we were talking to our friends over at Armanino, one of the obvious items that started to come out was the impact of this crisis on nonprofits. And so where this call series, this webinar series was really born, was really in the desire to help our nonprofits come together and facilitate conversation. And what Armanino just walked through with their resource center is really trying to be a conduit to information and to provide feedback in a way for organizations to try to plan in this world where there's so much uncertainty. And Marie, if you could just go forward one slide. What we started to hear from our nonprofits, and Armanino did as well, was that that's just it. There was so much uncertainty going on in March, and how do we start to get our arms around some of these topics and items that are new to all of us, but likely to be around for a while. And so many of you saw, and thank you for filling out the survey that was put out in March, and it gave us a lot of really good insight and data into common challenges and common questions that are within the nonprofit world. And ultimately what we are launching today is this 3-part call series around 3 of the most topical items that came through that survey, to hopefully start some conversation and hopefully provide some answers and provide a way for folks to come together and discuss in a world where it is very hard to do that today because of the crisis. So today, as Matt and Mike mentioned, we're going to discuss the Paycheck Protection Program. A lot of questions around guidance, compliance, and what it means for your audit. Matt's an expert on all of those items, so it's going to be great to hear from him on what those items are and how we should think about them and answer some questions. Next week, hope everybody can join as well. We're going to have a really good conversation about strategic planning. I keep using the word uncertainty, and that relates to so many things in today's world. And what we've heard from so many nonprofits is there is so much uncertainty around, whether it be reopening your organization, around revenues, around operations. How are organizations adjusting in this world where we have so much uncertainty? And we've got 3 great speakers next week to talk about what they're doing and how they're seeing best practices on the ground floor within the nonprofit world. We've got Jason Siever from the Fine Arts Museum, a museum that's been closed now for going on 4 months, and about 3 days before they thought they were going to reopen, they had to close again. So they'll be able to share information that I think a lot of organizations are dealing with around, having to close and what their plan is, short, medium, and long term for, the plan in this world that we don't know what's changing day to day. And then Jennifer Venor from UniHealth and Vanessa Bechtel from Ventura County Community Foundation, who have spoke to hundreds of nonprofits over the last couple of months that are dealing with all sorts of issues and have a lot of really good information about how different organizations are adjusting and dealing with the crisis in various angles. And so it'll be great to get feedback from different parts of the nonprofit world about the challenges and what ultimately people are doing around those challenges currently. And then just lastly, on the return to work the following week, return to work really means 2 different things. It can mean return to work within your organization and your staff, or return to work within your mission and your cause. And for many organizations like the YMCA, they never really left return to work, because as the case is for many folks on the call today, your mission, the need only got greater as the crisis got deeper. And so the YMCA was very innovative in the way that they were able to continue to serve their constituents and really innovate around safety protocols as the risks increased. And so it'll be great to learn from them what they did and what they continue to do to be able to serve the community, but to stay safe. And then TheaterWorks, which has a whole different set of organizations given their setup and their services and how they're trying to adjust. So again, the goal is really just to get folks together and discuss and hopefully have answers, or if not answers, start to lead towards answers, and we're open to feedback, and hopefully this leads to more conversation down the road. So with that, I'll hand it back over to Mike, and we can jump in.
Yeah, and just to add on to some of the structure of this series as well, and really excited to talk about the return to work on the 30th of the month as well. We'll go into a little bit some of the ways we've been hearing from those clients, but also how we've been trying to help too. As I mentioned, our COVID Resource Center, one of the things we have up there is a COVID tracker. It's a live, up-to-date database of COVID trends in every county, every state nationwide. So you can log in and see that. That's been helping organizations determine when and how to go back to more normal. And we're also pushing out a return to work app. So a way, again, organizations can facilitate getting their employees back into their facilities. How will they accommodate social distancing and all the logistics that go with that. So we'll speak a little bit of that. We can hear from our nonprofit counterparts of the YMCA and TheaterWorks on the challenges they're facing in two very different ways. And as Jason alluded to, the second and third of this series, we really want you all to hear from your peers, other nonprofit organizations. We want you to hear the stories that they have, the challenges they're facing, and then ask them questions. And so those two other sessions will be much more focused on our panelists of our nonprofits. Today, given the PPP topic, the highly technical nature of it, and how unique the challenges are to every organization, we're having Matt join to speak and share a lot of the common questions we've heard and answer some of the questions you likely have today, given if we had some of our nonprofits join, their challenges might be so unique to their specific situation. So that's our structure of the three-part series, and we can jump right into more about PPP today. As Jason alluded to, really the catalyst to some of this conversation in these three-part series is the survey that we conducted collaboratively between our both of our firms to both of our nonprofit communities. We distributed a survey. It was 17 questions. Many of you filled it out, and we thank you for that. It was sent out mid-May through early June. Ultimately, there were about 160 responses to the survey. Most of them were complete, but we still retained the answers if it was a partial completion of the survey questions. It was relatively quick. If you recall, it took about, on average, 8 minutes to complete. Again, the goal was to generate as much data as we can from our nonprofits of varieties of sizes and sectors that you're serving to see if we can find some common challenges and then facilitate some of these Q&A sessions that we have. So we'll dive into a few of the answers to the surveys to give you an idea of who were the organizations that filled out the survey. And then we'll go through some of the survey responses specific to PPP topic. We won't go through all the survey questions and answers today because we're going to save some of them for our part 2 and part 3 of this series. So today we'll focus on the PPP questions only. So who were the types of organizations that answered the survey itself? By region, you can see on the left here, predominantly California, given Canterbury and ourselves are heavily involved in the California nonprofit community, split fairly well between Northern California and Southern. But we did get some responses from throughout the rest of the country in Texas and the Midwest and a few in the East Coast. Who were the individuals filling out the survey? As you can imagine, mostly the C-suite executives of the organizations, the CFOs and the CEO or executive director, just about 70% of total responses. Some were also in the finance office as a controller. And a few responses came from a board or committee level, or other positions for some smaller organizations that may only have one individual wearing multiple hats. In terms of the sectors and the types of organizations that filled out the survey, probably no surprise, a spattering of every subsector within nonprofit, but there was a concentration in social services and education, and not too much of a surprise to us, because as far as we've heard, those are two sectors, in addition to arts, that have felt some significant pain through the COVID crisis, and therefore very interested in hearing about what their peers are doing and how they're reacting right now. So big concentration there. Over 40% of the survey responses came from social services and education, another 13% from arts, and then a spattering throughout the other sectors. So good to see a good diversity in who responded to the survey. A quick answer for you on how large the organizations are that filled out the survey. Again, pretty diverse responses here, but 22% were over 50 million in assets. We just did a quick answer on a question on your total assets, as opposed to getting into too many details on expenses, operating budgets, or revenues. But pretty diverse in the 20% here across all sizes. Not very many responses came from organizations that are under $1 million, and that's fine. So we have a good spattering here. So those are some of the general characteristics of the responses, the types of organizations, the 160 plus that answered the survey, and we'll get into here some of the findings, some of the takeaways from the survey results, again, specific to the Paycheck Protection Program. And Matt and Jason will chime in as they like to share some of their experiences, stories they've heard from other nonprofits. As we get later on in the call, Matt will share a lot of the frequently asked questions we've been hearing, both from you joining today and throughout the past few months related to PPP. So one of the first questions we asked in the survey was very simple. Did you apply for a PPP loan? Yes or no? No surprise, overwhelming majority, 81% responded yes, they applied. Again, this survey was distributed in late May, so very early on in the process when things were changing, gosh, every single day, if not hourly. Matt remembers that, staying up to speed on the constant changes on the PPP loan application process. There was a lot of unknowns. We didn't know necessarily how to do the application. What bank do you go to? We'll get into some of those questions. But no surprise here. The overwhelming majority of you did apply for a PPP loan. And then next, moving on from did you apply, how did you go about doing that? What channel did you use to apply for your PPP loan? Almost 80% of you went through the bank that you normally do business with, so your primary bank, your local bank that you're working with currently, which is what we expected. I think when this started, Matt and I actually, I think, spoke with each other about it early on, of just would we even expect to see our nonprofit clients go to a different bank, and would that bank be willing to lend to a new customer? And so I think no surprise to us, it was mostly current relationships. It might have been a challenge to go to a brand new bank if you weren't currently a customer. Matt, that's what you.
Yeah, I think we saw that, especially as everyone recalls, there were really two waves. The initial wave happened really quickly. I think people had the application in before the application was even final, and it was, I think for most organizations, you really had to have a connection with the bank, and we saw that because everyone knew they only had a specific allocation. That second round, there was a little more availability, and even today, there's still 130 billion left in PPP funds. We're starting to actually see more people asking about organizations that didn't file previously, having some interest in applying now. So it used to be that you had until June 30th. So for any organizations that haven't applied but are still considering it, you now have until August 8th.
Interesting to us, there's a number of responses to this question of other. So you can see here, most of the answers were either a third party applied on our behalf, we applied through a bank referred to us, or a current banker. 7% of you responded was something else, a free form answer here. And as we went through the data there of the survey responses, it was a variety of unique circumstances. Some of you used a loan broker. Some of you went to your current bank and your bank said, we aren't participating in the program, go use another bank. Some of you went to your bank and they just did not reply. We saw a number of answers to this question there. You said, I went to ask my bank, how can I go about applying for the loan? And you never heard from them at all, which is probably proof that the bank was overwhelmed with applications and simply had a hard time keeping up with bandwidth there. So interesting to see, again, some unique circumstances even at the very beginning of this entire process. So current status, again, here we are July 15th. It's been, gosh, 3 months since this all started, since about the beginning of the PPP process. Again, this survey question went out late May. What was the current status of your PPP loan application at that time? 82% of you had said you received the funds already. 9% you had received approval, you were awaiting funding, and then a few of you were in a different status. Fast forward to today, I'm sure this would be a much higher percentage that you actually received the funds. We would actually probably add on a question of where are you at with your loan forgiveness process or maintaining documentation, which we'll get into some of those challenges as we talk about some of the frequently asked questions. The big question of what are the PPP funds and proceeds going to be used for? How do you anticipate those funds to benefit your organization? By design, the funds are meant to protect salaries and wages and employee compensation to maintain employment levels. So no surprise to us that 59% of you responded that you expected your loan proceeds to delay layoffs, hopefully completely or forever. 62% of you responded that the loan proceeds would provide a temporary cash cushion. So maybe you already have some cash reserves, but that you were going to start depleting to continue to provide compensation to your employment base through these difficult times. And the loan proceeds were used to either replenish that cash cushion or just give some comfort and flexibility during these months. So definitely no surprise there. Jason's probably heard similar comments there on just what do we do with our operating reserves, our investment balance? Should we pull it to cash to get through these tough times?
Yeah, that was key, you know, alongside the conversation of PPP. And it's great to see some of those numbers, Mike, that the success rate has been so high at this point. But I know in March and April, it was pretty hairy as to if you're going to get your loan, when you're going to get your loan, just getting a call back from the bank. And so there was a lot of conversation in that time period about, you know, how do we secure our short-term needs? And, you know, unfortunately, that was sort of the worst time to be thinking about rebalancing your investment portfolio and trying to pull money out of there. So, you know, luckily, a lot of clients were very active and able to not go down that road. And got a loan and were able to play that short-term uncertainty off. But it was a challenge, and that's something that some people had to think about. And then luckily with the loan, you're able to stave that off. I'm guessing that in that provide a temporary cash cushion number of 62%, if the loan had not come through, you know, the next source of funding would have been their endowment or, you know, foundation funds, which would not have been ideal at the time.
Yeah, absolutely. And again, one of the responses to that question was an other free form entry, a variety of unique circumstances there, but did give us some insight into some of the challenges our nonprofits are facing. Some folks answered that their loan proceeds were helping them specifically with hourly employees, not so much their exempt employees. Others commented that it allowed them to maintain certain programs that they would otherwise have to cut completely. So again, maybe a more specific area of their organization as opposed to a widespread factor within the entire organization. Now, of course, the question of folks that did not apply for the PPP loan, which was the question there is why? Why not? What reason did you not pursue the PPP funding? Many of these answers were very unique or didn't align with the questions we included in the survey. 36% of you did say that you just did not need the funding. You're an organization that has strong cash reserves, strong working capital, a strong endowment that you're able to draw into. And so you did not feel it was appropriate to apply for the loan. If you recall, at that time, there was lots of uncertainty around criteria to be eligible in the first place. There was some media attention around private education institutions that were applying and being approved for the PPP loan when they had significant donor endowments to help them weather the storm, but there was confusion on, again, the definitions of that necessity. So we did see a number of you that did not pursue this at all, given your ability to be flexible through these difficult times. 18% of you did not qualify purely due to size. The threshold, Matt, I believe, was 500 employees, right? If you have more than 500 employees, correct, you don't apply in the first place. And then a variety of other answers, although there was a common denominator. Many of our survey respondents are 501c6 organizations, so they were not eligible. Matt, were there other tax-exempt categories that were not eligible, including 501c6s?
Yeah, it was primarily the only nonprofits that were eligible were 501c3 veterans organizations and tribal organizations. So it's now the HEROES Act that was passed by the House but not the Senate, that did expand it. It expanded it to all nonprofits, so that would have gone beyond the 500 and also would have included any nonprofit, including 501c6s, 501c4s.
Great. And next here showing up, and I believe this is the last survey question we're going to speak to until we get into some of the specifics of PPP challenges. But are you taking advantage of any other federal programs aside from the PPP loan? There were other stimulus programs available to the nonprofit community and the greater country as well. Ability to defer payroll taxes, 14% of you took advantage of that. There was an employee retention credit for those of you that were retaining employees. You could receive some tax benefits there. Sick leave credit, and then, but in the great scheme of things, 66% of you did not pursue any of those other programs and only pursued the PPP loan proceeds. Matt, did you see any common characteristics here?
Yeah, I think one thing so the payroll tax deferral was something that organizations were able to do. So essentially you could defer your current payroll taxes to 50% needing to be paid back December 2021 and the other 50% December 2022. So it's essentially a zero interest loan from the government related to your payroll taxes. But a lot of organizations didn't necessarily go to that because the CARES Act specifically said you can't defer the taxes if you have had loan forgiveness. And so originally it was clear that you had to cut that off at that time. So a lot of organizations didn't go there. The PPP Flexibility Act did say even if you have forgiveness, that you can still defer taxes. So that is something that organizations that are looking at cash flow can still take advantage. So you can defer your payroll taxes through the end of 2020 and save you a little, just from, obviously it still needs to be paid, and I think that's what I've heard. I don't, a lot of my clients haven't been interested in that. I think they felt like it was a lot of work, and ultimately it would still need to be paid back. But others that I've spoken with and other subject matter specialists at Armanino have been saying this is easy. This is essentially, it's a free loan if you need the cash flow. Now the employee retention credit, you could only do one or the other. You can only get either the PPP loan or the employee retention credit. There were some requirements there, and I think everyone realized if you had a choice between the two, the PPP loan, to the extent that you can have it forgiven, is definitely better. And then the reminder that if you have any emergency sick leave that is under the FFCRA that you're paying and you receive the credit, that you don't actually pull that into your PPP loan forgiveness.
Yeah, it's interesting. And I wonder if you heard from clients, again, back to your comment of why folks did not take the payroll tax deferral option? And was it more so because the PPP loan proceeds, once they got the math right and determined the amount that they could use, and it was sufficient to help them get through this time frame and maintain payroll, was that enough? And then they looked at, well, there's other options, but boy, it's a lot of work, it's confusing, and it's all happening at the same time. And we feel like maybe we got enough funding from federal programs, not to mention other fundraising sources some of our organizations were doing at the time.
Yeah, and I think, I know some, especially smaller nonprofits, the board gets a little bit nervous anytime they're dealing with payroll taxes, because ultimately, if the payroll taxes are deferred, they still need to be paid, and if the organization goes under, the board's on the hook. So the board tends, at some organizations, tend not to really like that. But if you're still a strong organization that is just needing cash flow, I think it's still a great option.
Right, that's a great point. I heard that as well from some nonprofits that, although we all knew PPP would be forgivable, there was a lot of confusion of how and when, and doing the actual math behind it. And at the end of the day, up front, it's debt. And then deferring payroll taxes to some feels like more debt. And we're just deferring the inevitable. And if we use those funds now, how are we going to come up with it later? And so the conservative approach was maybe just take the PPP loan and move forward.
And I think a lot of people have their hands full. I think a lot of it comes down to there's only so many hours in the day, and everyone's dealing with working in a different environment, and kind of to the point where I'm focused on the PPP because of the loan forgiveness aspect. Payroll tax deferral would be great, but really it's just a timing issue.
Perfect. So I believe now, again, we'll go through some of the other survey questions in our future part 2 and part 3 of the 3-part series here. But we'd like to spend the rest of our time going through a lot of the PPP specific issues, challenges, questions. Many of you, when you registered for today, submitted some questions. We have answers for you on those. And so Matt's going to guide us through a lot of the typical questions, some answers. We can have a discussion around those. I can also speak to some of the financial reporting and the accounting of these PPP loan proceeds, how that will look in your presumably a June 30, 2020 financial statements, your audit, what questions is your auditor going to ask, so we can navigate a lot of these issues here now. So Matt, I'll let you take it away.
Great. So I think maybe I'll just sort of start with making sure everyone knows that the U.S. Treasury site has a lot of information about the PPP program, all of the guidance, all of the applications. That's usually the first place to look. So if you go on the U.S. Treasury website and there's a banner, red banner, that'll get you to the PPP loans. So obviously there's been a lot of updating. We are still waiting on guidance from the SBA since the PPP Flexibility Act has come out. And so that's obviously the big change there being the push from 8 weeks to 24 weeks covered period. And so there are some questions about organizations that are looking to push to the 24-week period that the current guidance doesn't necessarily say everything that organizations are thinking and some of the factual situations. So we still do expect further guidance. As of now, we've been dealing with we have 49 frequently asked questions that the SBA has issued and 22 individual interim guidance issuances. So there's really a lot out there. We've had multiple loan forgiveness applications. So the SBA has updated the loan forgiveness application and instructions since the PPP Flexibility Act. So I would say make sure you've taken a look, see what's there. It can be a bit overwhelming because of how much guidance has been needed, but again, there's still guidance that is needed kind of beyond. And so a lot of what I'm going to go through, I'll go through as many of the FAQs as I can, and hopefully touch on what we see as recurring themes, so that the facts may be a little bit more generic than what you specifically need, but it should answer most of your questions. And we do have many of the FAQs kind of referring back to our website as well, the COVID resource page. as a good way, but I'll try and get through as many as I can. Maybe kind of starting with what expenses can be forgiven. Remember, these are payroll costs, which are the gross wages, the employer payment of medical, employer retirement payments, and any state unemployment, which obviously is a little bit different when we're dealing with nonprofits, because I think most are reimbursable employers there. But you can also include rent, utilities, which are electricity, gas, water, phone, transportation, which we believe is essentially gas if you have a fleet of vehicles. That kind of I think that's really what that's meant to do, and internet. But these utilities should have been in place before February 15th of 2020. So don't. The goal wasn't to go out and add more utilities, just to be able to get them in there. And also interest on mortgage obligations. So that's real and personal property, but not the principal. Obviously the payroll protection, the Flexibility Act, what the other big change there was to reduce the required payroll cost from 75% down to 60%. So I know a lot of organizations were concerned about being able to get to full forgiveness because you had to at least use 75% of your loan proceeds on payroll. And then there was a cap to the extent that you didn't. So that's been reduced down to 60%. So that, coupled with the ability to push the covered period out to 24 weeks, has made it to the point where everyone should be able to spend 100% of their proceeds within the covered period. And I would recommend, I know you do have the choice. So I believe the date is, if you received your loan proceeds before, I believe June 5th is the date, you have the option to take either the 8-week or the 24 weeks. So if you applied now or you receive the proceeds now, you would be obligated to use the 24-week period. So for organizations that are considering, I've said run through both scenarios. You should get as close to 100% as you can. So if 8 weeks doesn't get you there, then look to the 24-week period. I think the risk in the 24-week period is, am I going to have any reduction in force? Do I need to lay off people? And to the extent that I do need to do that, because remember, it's there's really 3 different things you need to do to get to full forgiveness. The first is, I need to spend the money. I need to spend the money on the allowable costs that I just mentioned. And then there's the 2 different haircuts. The first we need to look at is, did I have any reduction in wages of greater than 25%? So that's on an individual employee basis. For example, if I had someone who's made 100,000 and now they're making 70,000, so that's a 30% reduction, and we're talking annualized. So that would essentially be a $5,000 reduction that I could not take in loan forgiveness. So you have to go through that to see if you have that reduction. And then the next is, did I reduce my FTEs? So we have 2 different periods we're looking at you can choose from. So the numerator of the equation is our covered period. So whether it's our 8-week or our 24-week period, it's how do the FTEs during that period compare to one of two periods that the SBA allows you to choose from. And it's either February 15th of 2019 through June 30, 2019, or the first 2 months of 2020. So obviously you would take the one that would have the lower denominator, because you want to get, you want it to be 1. You want your equation to be 1/1. So hopefully the employees during your covered period, the FTEs, and an FTE is defined as 40-hour work week. And so that would be 1.0. You can't have an employee count as more than 1.0, but you have 2 ways of calculating the FTEs. The first is that you round to the nearest 10th. The next is anyone that is not 1.0, so anyone under 40 hours is considered part-time, which would be 0.5. And we've recommended go through both calculations and go with the method that works the best. So those are the 2 ways that you could have a reduction. But obviously, you would choose whichever period, 8 or 24 weeks, that suits, that works the best. Now, there has been a question of, well, what if I get through all of my funds in 10 weeks? Now, I think the SBA previously had been pretty clear. You have a choice between 8 and 24, and that's your covered period. You can't choose anything in between. But the SBA recently has said, well, if you expend your funds in 10 weeks, you can apply. So you don't have to wait until the end of the 24-week period to apply. There's still some questions, though. And I think for those people that are applying early, you do need to look at, you will have to extrapolate over the 24-week period to the extent that you have any of the reductions of wages of greater than 25%. But there is no guidance at this point as to how you handle the FTE calc that I just mentioned. What we've been saying at this point is it's reasonable to just do that FTE calc, not over the 24-week period, but when you apply for your loan. So if you apply after 12 weeks in, you would cut that calculation off there. Obviously, there's no guidance that clearly says that's the answer, but I think given that they had the opportunity to, the SBA, in terms of giving guidance on how you do that calculation, when they mentioned the 25% reduction extrapolation, I think that it's reasonable to go there. But obviously, we could have more information come out with guidance. Moving along to some of the questions, what the loan forgiveness application talked about an alternative payroll period. So that means if an organization receives their loan, let's say on May 2nd, and the next payroll run is May 7th, you have the option, if you are a weekly or a biweekly, if you have weekly or biweekly payroll, to start your pay period on May 7th. Otherwise, your covered period starts the day you receive your funds. Also a reminder that the wage maximum is $100,000 per individual, and there's been a lot of questions about this. There is a cap, so there's only so much that you can put down as forgivable payroll costs for each individual, and this really is the wage aspect of it. So if you choose the 8-week period, it's $15,385. If you choose the 24-week period, the maximum is $46,154. So my question comes back to, well, if I'm applying after 10 weeks, do I get the $46,154? And given that we only have those two options and that's all that's out there, I know it seems that it would be reasonable to say that you really would only take $1,923 per week as the cap. That's the weekly equivalent of $100,000, and there's no guidance there. But we do think it kind of goes against the intent that if I squeeze $46,154 in a 10-week period and get forgiveness, that ultimately that's not exactly what the goal was here. But if you're going to have an issue with that, then you can extend it beyond that 10 weeks. So I think with the 24-week period, you should be able to get full forgiveness, at least on that aspect of it. One thing that we've seen a lot with our nonprofits that receive federal grants, it's a key is make sure you don't double dip. So to the extent that you're receiving funds, federal funds that are paying for payroll costs, make sure you don't you don't include those costs in loan forgiveness. I think it's something just to make sure that you don't do. I think that is something definitely to stay away from. We have gotten questions about audit expectations and what do we know. I think there's really two different audit different ways that organizations could be audited. The first is, did we meet the need requirement? And I think for everyone who is aware of the back and forth and some of the press that got out there, The SBA and Treasury will audit, and said they will audit every borrower over $2 million as to whether they met the certification of need. We have been hearing that the likelihood is they may not have the bandwidth to be able to audit everyone, but anyone whose loan proceeds were over $2 million, I would say expect and be prepared to prove that you met the certification of need requirement. And then in terms of the actual loan forgiveness application, the bank is going to, they will do some form of audit. It's unclear exactly how detailed they will get. I think it may be on a bank by bank basis. And then there is also the sort of on the back end, the SBA does reserve the right to audit the loan forgiveness applications as well. So I think that the key there is what we've been saying all along is really make sure your files are clean, that the loan forgiveness application is clear, you have support to the extent that you're including rent, that you have the rental agreement to support it, you and any other agreement necessary, that you have the payroll that easily supports it. You've made sure that you've sort of separated the PPP versus other expenses. So I think it's important that you're really creating an audit trail, if necessary, that can easily be supported.
Yeah, and Matt, that's been a great point that we've chatted with nonprofits recently about. Again, if you're over 2 million, you should have the general expectation that you'll be audited by the SBA and questioned and double checked on some of this. And so if there's any doubt in your mind on whether you met the original eligibility, what we've seen some of the best do so far is memorialize those thoughts in a memo, share it with the board, share it with the executive team at your organization, put on paper effectively your case. Don't leave it up to the hands of an SBA auditor to try to understand donor restricted endowments and the availability of your reserves and whether or not you had sufficient liquidity to get through this. Make your case, put it in documentation now on why you had a necessity for the loan proceeds that's unique to your organization.
Mike and Matt, on that point, they're thinking about different organizations and different buckets of funds. If you just look at a balance sheet or, a P&L for a month, one can draw their own conclusions on liquidity and financial stability. So is there any guidance on how you pool or don't pool these assets and then how you distribute them back out for expenses, alongside that memo that you mentioned?
Yeah, I think that's the classic challenge right now. And part of that press that occurred a few weeks ago is nonprofit accounting and balance sheets are a little bit hard to understand for even those of you on the call and CPAs. And now you get into government agencies and it's even harder. So pooled assets on the asset side, you might have an investment portfolio and cash deposit accounts. That says one piece of it. But then you need to look to, are those donor restricted? Are there legal limitations on how you can access those funds because they may be a donor endowment, directed endowment? And so that's where, again, if all you gave were bank statements and a balance sheet, you leave yourself open to misinterpretation. Put that in a memo, document your circumstances. Not every organization is different. Every endowment is different. You may have locked up funds in alternative investments that you can't liquidate anyway, even if they are unrestricted for use. You may have board designations and intentions for how those funds are to be used. The whole picture needs to be told.
Great. We do get a lot of questions about what information is required. I think the first place I would go is check with your bank, but the application itself actually does go through some information. If you're able to see the application, and everyone can pull it down from the SBA site that I mentioned with U.S. Treasury. On the SBA application, page 6 gives you a long list of what exactly you need. And if you do qualify for the EZ, that's found on page 4. And maybe, I'm not gonna necessarily go, I know there's been a question of who is eligible for the EZ, and the requirement is actually pretty long as to the options. Fundamentally, the EZ is a shortened form that is available for organizations that just aren't going to have any of those reductions, the 25% wage reduction and the FTE reduction. So I think that from a high level perspective, that's what it is. So to the extent that you think you may qualify for the easy, take a look at the form. The instructions are pretty clear, and there's actually check boxes. So go through the check boxes to see if you may qualify for that. So what it fundamentally does is it removes some of the worksheets that you have to provide. To the extent you don't qualify for the easy, you have to look at pull out individual put information from an individual basis, and this is what you have to be able to maintain is individuals that made over 100,000 in 2019 versus those under, and just some additional information that you're going to have to capture. So the detail that you do have to go through when you're pulling the files in that ultimately will get into the application is really on an individual basis. So I think you want to make sure you're reaching out to your payroll provider as well. Hopefully they've been providing a lot of the detail as well, so they should be aware of what they need to help you with in your payroll run. Mike, maybe if you wanted to talk about the accounting aspect and how organizations should be looking to book. I know that we get a lot of questions because right now no one has received loan forgiveness. So maybe go into a little bit of the questions and how organizations should be looking at the accounting side.
Yeah. Natural evolution here has been the chaos of getting your application done, and then the questions around what does this mean? How do I get my funds? And what are the terms? And then here we are, that dust has settled a bit there, and June 30 has passed, and most of you are June 30 fiscal year. And now the question becomes, well, wait a minute, what does this look like on my financial statements? Is this debt? Is it a gift because it's forgivable? What is this going to look like in my financial statements that my board sees, that a foundation grantor might see? So we're starting to get more questions around that. And it's good, and we need to start to work through it together. The quick explanation is, first and foremost, legally, the PPP loan is structured as debt. It's a loan. It has a forgivable feature to it. It has a very low interest rate. And so there's a couple questions that come up is, well, do we treat this as debt on our balance sheet, or do we treat it as a grant? The AICPA recently issued a technical question and answer to this topic, effectively saying you have options. You can choose to treat this as debt, even though you have full intention of it being forgiven. If you choose to treat it as debt under, for those of you accountants on the call, ASC 470, if you choose to treat it as debt, then you need to wait to take it off your balance sheet and bring it into income until you have legal release of the debt obligation. So that would not occur until you get that letter that says you have been approved for forgiveness. You are no longer on the hook for the debt obligation. That may be some time down the road. We don't know when that will come. If you choose to treat this as effectively, in substance, a conditional government grant, which many view it that way, given you enter into the transaction knowing you're going to have either all of it or substantially all of it forgiven at some point in the future, it's synonymous with a government grant. You can treat it that way under nonprofit accounting, and similar to other conditional grants from foundations or donors, you would be taking that to income in a systematic method as you've effectively earned it, as you've spent your funds in accordance with the terms and meeting the conditions of the award or of the grant. So as of June 30, you could take, if all of it has been deemed forgivable, even though you haven't received approval of that yet, you've spent the funds in accordance with the terms of the PPP loan, you could take all that into income as of June 30, or a pro rata portion if you're straddling over the June 30 cutoff date. So there's a general consensus amongst many of us that if you are a nonprofit organization, you should probably treat this like a nonprofit conditional grant from the government. You should probably take some of this, what you currently have on your balance sheet as a liability, take it into income for the amount that you've already spent meeting those conditions. That being said, there's some unique situations we've heard of already. Private education is a unique situation where many of you took the loan proceeds not because of a shortfall of income in the spring. Many private education institutions have already received tuition income for the rest of the school year. They took the loan proceeds to protect them in the upcoming fall or in the summer and the fall. And so we don't want to have a mismatch of that income to the expenses you're going to incur. So they may choose to treat this as debt, leave it on the balance sheet as of June 30, and take that forgiveness or that grant income in their fiscal year 2021 to match the expenses they will be incurring then. So there can be some unique twists, but I think generally we're hearing many of our clients are going to be treating this as a conditional grant, and you'll have some income in your fiscal year June 30, 2020 financial statements, either all of it or a significant portion.
Great. And given the timing, I'm going to try and hit some of the questions that I hear quite a bit of. Remember that you can include expenses that are paid and incurred during the covered period. So essentially, that's the requirement. So you can't pay expenses that happened a year ago from 2019, but the best way to look at it is on, especially when we're talking about payroll costs, because that's usually the that's usually the big question. Is I received my money May 11th, but my first payroll run is May 15th. But the May 15th payroll is for days May 1st through May 15th. Can I use May 15th as paid? And the answer is yes. So essentially, even though you're pulling in some of the days that happened before the covered period, you can include that. And then what the SBA has allowed are what we would call a stub period. So if your covered period ends June 18th, but your last payroll was June 15th, and you're semi-monthly, can I include the 16th, 17th, and 18th? The answer is yes. You can include those as long as those expenses are paid on the next regular payroll. So as long as they're paid on June 30th, the next date, you can include those 3 days. So I think that's something important to note. A few other things. Some of the new, the Flexibility Act and some of the new SBA guidance on their loan provided a few FTE exemptions and exceptions kind of in the safe harbor realm. So anyone who's had individuals, and this is getting to the FTE calc, who was fired for cause, resign, voluntarily reduce their hours, are furloughed and refused to work after receiving a written offer, they don't count against you. And then also to the extent that the CDC, the Department of Health, or OSHA regulations limit your organization as to how you can operate, there's a safe harbor for that. I think the key consideration is, are you following state and local regulations or guidance from those federal governments? I think an example is if the social distancing requirements make my organization only able to operate at 50% capacity, then if I have a reduction in employees due to that, that won't count against you. So I think there's a few of those that are a few organizations that may be able to take advantage of that. Reminder that we get the question of, when do I need to apply? And the answer is 10 months after the end of your covered period. I think most organizations will be looking to essentially file as soon as they can. I know that I don't think most organizations are going to be concerned about the 10 months. Most, especially schools, are looking to get the loan off the books as soon as they can. See if there's any others, given we only have a couple minutes left. Reminder of the FTE safe harbor. So any organization that reduced their FTEs between February 15th and April 26th, you can restore the FTE levels no later than 12/31 to that February 15th date, and you're not penalized. So if you had an initial layoff, you can bring those employees back and not suffer an FTE reduction. Maybe the one more. I think those may be the key. I'll take a look and see if there's anything else that we may want to touch on by this point, but I think those are some of the key areas. I don't know, Mike or Jason, if you have anything else you wanted to touch on, or maybe before that, I'd say just kind of reminding everyone that there's definitely a lot. There's a lot out there. Be mindful that it's changing. It's still changing constantly, and we still expect guidance. I'd say the first place you do want to look is go to your bank, see what you need to do. They may have their applications. Some have their applications up, some are not quite ready. To the extent that you do need assistance, there's organizations that can help you. I know Armanino does have an SBA team. If you do look at the Armanino SBA, I usually just Google it just to get to that. We have a team that does do the loan applications, but there are other organizations that help as well.
Yeah, absolutely. No, thank you, Matt. Again, we can't answer all the topics, all the questions in 1 hour. There's so many issues with PPP. So we'll continue to be putting out guidance and resources on our COVID-19 Resource Center. For those of you that submitted questions that we didn't get a chance to get to within this hour, we'll do a follow-up to try to touch base with you. Matt, myself, and Jason are always available to all of you as well if you want to reach out with other questions. And as we mentioned, we'll have part 2 and part 3 of this series to talk about some other topics and have some of your peers join as panelists so they can share their stories and you can ask them specific questions around either returning to work or programs or strategic planning for the future and how foundations are trying to help the nonprofit community with funding sources during these difficult times. So our information's up here. Feel free to contact us. I know Jason's welcoming to speak with any of you around whether it be asset allocation or how to weather the storm with your investments or cash on hand. He's a very helpful resource with that, and we're here to help on anything, whether it be accounting or PPP. So we thank you for joining us, and we wish you a great rest of the day.
Thank you.